Hello, good people, and welcome back to Econ. We are now in Unit 3. We have knocked out Unit 1 and Unit 2 on Intro to Econ and to Choices. We've discussed all kinds of things from the value of money, four types of money, education and income, post-secondary options, how to pay for college, all that kind of good stuff. And now we're going to get into taxes, okay? So in this first installation, we're going to kind of just give you a vague intro, just kind of like what kinds of taxes are there, how do you collect them, that type of thing. So first and foremost, what is a tax? We can define this as a mandatory payment to the federal, state, and local levels of government from income or profit of a person or a business, okay? Individual or corporation. So the key word here is mandatory because it is necessary in order for the functions of government to continue. All right, it dates all the way back to ancient Mesopotamia and ancient Egypt, like all the way back to like the pyramids type of times. Okay, here's Mesopotamia. All right, so let's see what the founding fathers, at least three of them, have to say about taxes. George Washington states that it is essential that you should practically bear in mind that towards the payment of debts there must be revenue, so income, that to have revenue there must be taxes, and that no taxes can be devised which are not more or less inconvenient and unpleasant. So George Washington's impression of taxes are necessary and stressful. Okay, now Thomas Jefferson, if you remember back from civics and economics or civic literacy, this is Thomas Jefferson, the man who wrote the Declaration of Independence. He didn't write it all himself, he did have help, but he physically wrote it down. So he says about taxes, the purse of the people is the real seat of sensibility. Let it be drawn upon largely, and they will then listen to truths which could not excite them through any other organ. So Thomas Jefferson thinks that if you mess with people's money, they are going to start talking about whatever you're trying to pay for in government. So the way to get people to listen and pay attention to what is happening in government is to tax them. The third one is James Madison. So he says the power of taxing people and their property is essential to the very existence of government. Now, James Madison has kind of hit the nail on the head, so why do we even have them in the first place? Well, we have got to fund the four functions of government. And if you remember what they are from civics, I sincerely hope that you do because there's a question coming up. If you said security, order, services, and public policy, you would be correct. So, for example, the United States Postal Service, taxes fund the mail. Taxes fund national security like TSA at airports. So they check people to make sure that they're not carrying on any excessive amounts of liquid or anything that could be potentially used as a weapon or as an explosive while in the air. Public schools are paid for by state and local taxes, and like speed limit signs and roads and the paint on the roads for them to be redone. All of that gets paid for by state and local taxes as well, and sometimes federal. All right, so before we get going, is there any lingo you should know? Yes. There is an additional one on your note sheet that says levy. Okay, this is a listening check. Please make sure you are listening. And those of you who are reading the closed captions, please pay attention to this. To levy is to put or collect something. Okay, and in our case, we're talking about taxes. So to levy is to put or collect something. To put on or to collect something. All right, a deduction is anything subtracted from the amount you pay. Itemized, if it's an itemized deduction, instead of like a regular deduction or what's called a standard deduction, just being like swiped off the top and that is taken away from the amount you pay. And in today's tax codes, it's $12,000. So 12 grand is immediately taken out of everybody's amount that they're supposed to have taxed. An itemized deduction is the list of items you can subtract from how much you pay. So instead of just having a standard set amount, you take a list and make a list of things that you can subtract from the amount you pay in taxes. A bracket is a level of payment for taxes or a percentage from your income. A tax return is paperwork with amounts paid or owed. And a write-off would be things that you can or have subtracted already. So anything that is a write-off goes in an itemized list to be deducted. Okay, we will get more familiar with these terms as we move throughout the unit. So how many are there? Well, like Forrest Gump is out here saying and Bubba Gump is out here saying, in the States we got all kinds of taxes, okay? Now, we can categorize these into three main groups. The first category of taxes would be income. The second set would be property. And the third would be goods and services. So income would be your wages. Property would be your assets. And I hope you remember what assets are because there's a question coming up. If you said things that add to your profit, You'd be correct. And then for number 3, goods and services, that's anything that you purchase. Okay, so under the category of income, we have 4 specific taxes. The first one is just a straight up income tax, and that happens at both the federal and state level. So under federal, we would write that it's a larger percentage of your wage, and it's taken out of your wages based on your level of income, based on brackets. Okay, at the state level, it is also taken out of your wages, but typically at a smaller percent, and 9 of the 50 states do not have property taxes. Income taxes. Whew. Okay, so for example, here they are. So Washington, Nevada, Wyoming, South Dakota, Texas, Alaska, and Florida do not have any sort of income tax on any type of income, your active or your portfolio income. Okay, now on the other hand, Tennessee and New Hampshire, both of these 2 states have capital gains taxes. Okay, so they'll tax anything that's an asset, like a stock or a bond or real estate if it reaches a certain amount, but they will not just slice out part of your paycheck. And I hope you remember what portfolio income is, because there's a question coming up. If you said that it's assets like stocks or bonds rather than liabilities or earned income, you would be correct. All right, let's move on to the next one. This is called payroll taxes. Regardless of your income, if you earn a wage or a salary, you have to pay payroll taxes, because at some point, everybody will use them. Okay, so Social Security comes out of your paycheck, and Medicare come out of your paycheck as well. This is a result of FICA, or the Federal Insurance Contributions Act, that was passed in 1935 and then again in 1977. So Social Security is a cool 6.2% right off the top of your wage, and Social Security is a social safety net for retirement based on the lifetime average of earnings that you have. So at some point, when you retire, you're not going to have any income coming in every month from your job, because you stopped working your job after you've worked for 30 or 40 or however many years you choose to work. So whenever you are old enough to reach Social Security and get your full benefits, which at this time is 66 in 3 months, is when you can start drawing, and then you can keep drawing, and you can draw your full amount at 67. When you are older, you can draw some sort of partial help from the government from Social Security, because you have paid into it over your life. Now, on the other hand, Medicare is insurance for the elderly. Here's the deal. Most people's insurance, or their health insurance specifically, is attached to their job. So when they leave their job and retire, they no longer have any insurance. So when they go to the doctor's office, they don't pay $3 or just $20 a visit. They might be paying significantly more. So in order to insure people who are no longer working because they have retired, we have a national insurance system, and we call this Medicare. It's specifically for the elderly, not Obamacare or Medicaid. This is specifically for the elderly, and that is 1.5% taken off the top. Now, you contribute 6.2 and 1.45, and then your employer contributes 6.2 on your behalf and 1.45 on your behalf as well. Okay, all right, so it looks like this when you get your little statement of what your wages look like and how much has been withheld by the federal government. So the federal government has withheld $222 of this person's check for just federal income tax, and then Social Security tax at this point is $152, and Medicare is $35.62. All right, so capital gains tax, which I referenced pretty briefly when I discussed income, will be taxes on sales of any assets. Okay, so anything that can bring a profit to you, but usually stocks and bonds. Okay, so bonds is like you contributing money to the federal government of your own free will. And then after a certain amount of years, typically 20, that money will have doubled in an amount. Okay, and so if you receive profit from that, you get a tax taken out of those profits. Stocks are the same way. So if you buy a piece of Amazon or something else, that is another thing that gets taken out. So you pay capital gains taxes on profits from stocks. It only counts for real estate, though, because if you're like, well, real estate also counts as an asset, that's true, because land or homes or businesses or anything that you own, they only count for real estate if you meet money and residency requirements. Here's the thing about capital gains taxes. This is only a tax if you sell the asset. Okay? So not if you just have the asset, if you sell it. Okay, so for capital gains taxes, it counts as $250,000 or greater, or $500,000 if you're married. Our last type of income taxes is estate tax, and this is a tax on the value of inherited goods or assets, so things that you receive after someone's death in their will. And this we can categorize as generational wealth. So this is any type of wealth that is passed down, any type of asset, whether it be cash, stocks, bonds, a trust, anything like that, that is passed down from one generation to the next. And this is typically called a death tax. That is not a nice nickname, but it is collected after someone's death. So if they're passing down huge sums of money, the government receives benefits from that. All right, and typically estate taxes are only on like $750,000 or more. So unless you are passing down $750,000 to someone in the event of your death, that will not be taxed. And there's your Star Wars meme of the day. All right, and we will pick up with, we'll finish up property taxes so we can get to the front side of this note sheet. So for number 2, property taxes is literally a tax on anything that you own. That is your property. Who would have thought? Okay, so cars, boats, real estate, etc. Most property taxes are collected by the state and the local government and not necessarily the federal government. Okay, so and they are typically referred to as ad valorem taxes. Okay, so they are taxed based on the value given by the government. Can't speak today, okay? So there are 2 sets of values that a piece of property or any type of property can have. There's the tax value and there's the market value, okay? So the tax value is given by someone asking on the government's behalf, and market value is agreed on by the buyer and the seller together, okay? That's the agreed upon price, or what is a normal price, based on whatever that item is. Say, for example, a house. Let's say that it is listed online as being $100,000 to purchase the house. It's probably only valued at about $80,000 to $82,000 by the government, and they tax that amount rather than the full amount of its worth on what's called the market. All right, so how do property taxes look in different states? We are 34th in property taxes, so a little more than halfway down. New Mexico is number 1 for property taxes. They have the smallest amount of property tax. New Jersey is the worst for property tax because they have very little space and a lot of people who would like to be there. New Jersey and Connecticut, I think, are pretty much tied, okay? And I think Connecticut might even be worse at this point. So these specific places up here in the Northeast, a lot of them have very small amounts of space and a lot of people who would like to be there, so they have more property taxes. And we will finish up goods and services in part 2.